You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky tune means it's time for the funkiest show here on the old network. It means it's Thursday, 1:30 p.m. Central, 2:30 p.m. Eastern. Yep, it's time for TWIFO. This Week in Futures Options, the program where we break down what's going on the other side of the fence, the futures options side of the fence. A lot of energy, probably some metals. There's going to be a lot of equities in there as well. The equities are inescapable these days. They're leading the markets to the upside, to the downside from a vol perspective, certainly on top of a lot of your minds out there as well. So we'll be getting to those in a little bit. My name, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope so, the Options Insider Radio Network. We'll settle for informative, interesting. You add your adjective of choice there. When you leave in your reviews on your platform of choice, make sure you do that. Keep the new folks flocking in. I think a lot of them need it in these crazy times out there. And speaking of crazy times, I just found out a few minutes before the showtime, my usual stalwart here, my partner in crime, Mr. Sean Smith, over there at FTSE Russell, had to actually hop on a plane, which is not something anybody wants to do right now. Go back across country, rescue one of his sons who's trapped in college. So hopefully things are working out there. The dad's work is never done here. But don't worry, I got some two able cohorts joining me to help me figure out all of this crazy futures options madness. First off, since we're just talking about equities, holding down the FTSE Russell hot seat today in lieu of Mr. Sean is our old friend, the Rock Lobster, a.k.a. Mr. Andrew GIOVINAZZI from OptionPit.com by way of Carmen Line Capital. Mr. Rock Lobster, welcome to TWIFO, sir, and long time no talk.
You know what? I'm just happy I figured out where the mute button is.
We'll see. The show has just begun, so let's not jinx it. But
it's such early days.
So far you're good for the one minute you've been talking so far. It's good. We'll see. We got another hour or so to go, so we'll figure that out. And also joining us, holding down the CME Group hot seat today. By the way, of course, you guys can always play the home game for yourselves of TWIFO, not just during the show, but for the rest of the week as well, whenever you want. If you want to look up fluid milk at 2 a.m. on a Saturday, you can do that. CMEgroup.com/TWIFO is the place. There's not going to be a heck of a lot of trading at that time, but you can look at the reports nonetheless and see what's going on. So joining me to hold down the CME Group hot seat today, another old friend of the network, someone I was also just talking to not too long ago, our old friend, Mr. Uncle Mike TOSAW from St. Charles Wealth Management. Uncle Mike, welcome back to the TWIFO program to you as well, sir.
Hey, when you invited me to be on this show, learning about milk at 2 a.m, I couldn't resist. So I am excited to be here. And if you're not trading futures, then you're trading in the past.
Whoa, look at you. Ready to go. I like it. There's a reason why you're holding down that hot seat, sir. You're well trained. All right, since you came up with that great little nugget there, I will let you choose, Mr. Uncle Mike. We kick off the show every week breaking down all of the activity across the broad spectrum of stuff trading over there in CME land. We break it down into our movers and shakers report for the week, seeing what's lighting up to the light side or dark side. Uncle Mike, I will let you choose. Where should we begin our journey this week? To the light side or to the dark side, sir?
I'll always go with the light side, of course.
Of course. That's why I tossed it to you. I knew you would be going that way. All right, light side seems to be dominating the tape a little bit this week. Spoiler, listeners, you guys can find this information for yourself. Like I said, cmegroup.com/TWIFO. Go into that market scan section, hit the 1 week date. If you want to see exactly what we're looking at, you have to make sure wherever you're listening to, you adjust the dates back to this Thursday and last Thursday, you can see. So in between our shows, that's the time of frame we're looking at here. And if you did such a thing, you would see a whole heck of a lot of green on the screen. So it has been fascinating to watch this report over the past couple of weeks because it's all upside, then it's all downside, then it's all upside again, and it's all downside. This week we're back in the green category. All is right with the world, apparently, at least from a market's perspective. You get beyond that a little bit, things look pretty dicey. We'll get to that in a bit. But let's break down the upside. There's so much green, we got to do a top 10 list. It's not just the top 5. Number 10, the only real ag on the list, KC Wheat, number 10, up 7.27%. Normally that would be enough to get you firmly in probably the number 1 spot. Not this week. That's bottom of the top 10. Number 9, silver, Uncle Mike's favorite, up about 7, almost 7.5%. Number 8, the NASDAQ, up 8.01%. Then the Nikkei, up 8.08%. A lot of equities going to be on our list today, listeners. Number 6, the S&P, 10.9% to the upside. Number 5, the Dow, up 11.7%. Number 4, little energy fighting its way in there. Nat gas, up 12.18%. Number 3, our old friend usually leading the charts to the upside and the downside, doing pretty much that again this week. The Russell 2000, up 14.34%, outpaced in the equity land by only one thing, another even far more obscure index, the S&P Midcap 400. How often do we talk about that? And yet it's lighting it up again this week, up 16.28%. But that's not the number 1 spot. Nope, it's lumber. Got lumber sneaking in there, up 17% this week. Let's go to the dark side now. Number 5, palladium, off a paltry, a mere 1.96%. Number 4, soybean meal, off 3, about 3.17%. Number 3, class 3 milk, once again, dairy, breaking into the light side and dark side movers and shakers list, off 3.6%. Maybe you do want to check that class 3 milk report at 2 a.m. I wouldn't hold it against you. It's moving. Number 2, our old friend Lean Hogs. Talked about them last week as well. Off 6.01%. And number 1 to the dark side this week, Eurodollars, off 11.22%. So a lot lighting it up. As you can see, a lot in the equity landscape there as well, particularly to the upside. Most of the top 10 in the equity land, or I should say, and most of the top 10 across the spectrum coming from the equity landscape. By the way, you guys have a lot of questions about what's going on in the markets as it relates to coronavirus volatility. Sean mentioned on the show last week. Of course, check it out. FTSERussell.com has their coronavirus markets impact hub. If you haven't checked it out, I encourage you to check it out. They have articles there hitting there pretty much every day. Things like valuations have fallen sharply, but buyers should beware at these levels. How the vol relates between the S&P, or I should say the Russell 1000 versus the Russell 2000. A lot of interesting nuggets like that. So if you have questions about how this virus is impacting equities, and I know a lot of you do, it's a good hub to visit in between our shows. Well, let's get to it. Let's get to equities. We got to start there. It's just dominating everyone's tapes these days, listeners. And I mentioned kind of earlier on the option block, kind of it's worth repeating here as well. Coming into Showtime, by the way, we are seeing a bit of a rally, even though the rally seems to have mitigated itself a little bit right now. It was kind of selling off a little bit. Now it's like getting it back again a little bit, though. So wait 5 minutes, you'll see how much of a rally we're getting. But the market's in general rallying in spite of a lot of pretty terrible news for the most part. Terrible jobs numbers, 6.6 million coming out for unemployment benefits. That puts us at about a 13 to 14% unemployment rate right now, just over the last couple of weeks with the jobless claims numbers. So that alone, not exactly good. Also outpacing estimates to the downside. We have, former Fed Chairman like Bernanke coming out saying we might be in for a 30% GDP hit. Of course, the virus news out of New York State and other places is terrible. It's now the new locus globally for the pandemic, which is not a good thing. Death toll skyrocketing out there. So even though there is some hope, maybe that might be peaking, still a lot of bad news coming out of there as well. So a lot of pretty much terrible news coming out here in the light of the fact that we're seeing huge rallies out there in the broad equity space. Coming at the showtime, we saw VIX a little bit shy of 43 at about 42 3/4. That was down nearly 10 handles from where we were this time last show. We saw VVIX, which is the volatility of volatility, at about a 140. Puts us down about 11 handles from where we were this time last week. And RVX, which is our old friend, the VIX of the Russell 2000, at a 53. It's down 10 handles from last show. So small cap vol, still volatile, but coming in a little bit. That puts that spread at about 10 points. So that VIX RVX spread has been super wide over the course of the past week. All right, well, I started with the Rock Lobster before. Let's go around the other way. Let's start with Mr. Uncle Mike. Mr. Uncle Mike, sir, I know you like a lot of broad equity volatility, a broad equity exposure, particularly out in the S&P. Tell us, what's lighting up your tape out there right now? What are your thoughts on these, some might say, crazy valuation levels? Maybe you disagree. Maybe you think these markets are places to dive in with both feet. And in general, what you're seeing out there from a broad equity and indeed a volatility perspective, sir.
Well, a couple things. First off, like we had mentioned a little bit on the option block, or I talked about a little bit on the option block. From peak to trough with the S&P 500 today, and if you're listening to this show at another time, that's fine. I know a lot of these shows are archived, of course. But today, April 9th, I think it's a pretty key day for where we end up closing in the equity markets today, or in the cash S&P today, in that we're at about the markets have gained back roughly 50% of their loss from the peak of the market a couple of days ago. And so, or not a couple of days ago, like a few weeks back when the markets were at all-time highs. And so if I'm looking at this as a bearish person from a bearish trend, I'm viewing this as someone to where, okay, we're in a downtrend and we've taken a 50% retracement from the downtrend. I think today is a pretty important number, and this weekend going into Easter weekend is pretty important for those reasons, because I think those are some pretty key numbers with where we're at right now. Now, in terms of where volatility is in the S&P Mini and the options that are available on that, I think that we're at a point now to where if you are looking to be a put seller, that it might not be a bad idea to dip your toe in the water if next week you're okay taking on the risk. So in other words, let's say that you are, and by taking on the risk, here's what I mean by that. Are you willing to buy to close the put immediately, if not sooner, when it goes against you? Or are you willing to take on a larger amount of cash reserves, or put in a larger amount of cash reserves than you normally would, as if you were just looking to do, just say, a one-lot S&P day trade or something along those lines? So if you're willing to put in larger amounts of cash reserves, or, and I like to think, and in my case, or you're willing to get out of that short put if it goes against you, now might not be a bad time to look to start selling puts. Now, of course, if you get assigned, you'll be long the S&P E-mini, and you'll have to trade that accordingly based on what your goals and objectives are as a futures trader. But there are some fairly generous premiums. Now, you might say, well, Mike, couldn't I have gotten even way better premiums a couple of weeks ago with the VIX being around the 80 level? Why are you talking about this right now? Well, I personally don't like trading in markets where the VIX is at 80. My viewpoint on that is that I think that's kind of a market for crazy people, so to speak. There's another gentleman we host another show with that coined that phrase. This is a market for crazy people, and that's kind of my thought when the market is that high, and that I feel that it's too choppy to pretty much do anything in markets like that. So me personally, being the perma stock market bull with which I am, it's very difficult for me to do that. So I just simply step aside. Whereas now we have a little bit of stability. And if you're willing to take on the underlying, it's not a bad idea to dip your toe in the water if you have a bullish sentiment on the marketplace. Now, let's say that you like this market and you want to sell premium on it. Maybe a put spread might be something to consider as well. That's typically what I do in terms of being levered. So in other words, if I'm going to leverage myself, I like selling a put spread because of the fact that I have downside protection and I'm still getting a nice rate of return for the money with which I have at risk. So I typically prefer that to a levered short put. So those are some things with which I'm seeing in the S&P world. The other thing that I'm sure we're going to talk about as the show goes on is that slippery stuff. It rhymes with boil, and that it looks like oil. It looks like is negative on the day now. That we're waiting to see more details as to what's happening with the OPEC meeting. So with that, I will turn it back to Mr. Mark Longo and have him discuss things with the rock lobster.
I don't know why we would talk about oil on a day like today. There's nothing really going on out there whatsoever. Yeah, and by the way, like you mentioned, we always have to give that caveat now when we mention put selling, which is kind of implied, but we didn't. Rock Lobster mentioned put selling on the network not too long ago and didn't mention that you should always be prepared to buy the underlying at that price. And folks jumped all over him on Twitter, including Stock Nations and others. So we always have to put it out there, obviously, now that if you're selling puts, you have to be okay taking the underlying, taking delivery at those levels. I'm with you, Uncle Mike. Sometimes at 80, when the VIX is going crazy, those are not the opportune times for a lot of people to get in there and start harvesting the old quote-unquote risk premium because spreads are wide, markets are thin. If you get things off, you have to usually hit the bid or lift the offer, and those are not ideal levels, even if the volatility is high for things like that. So sometimes it does behoove some folks to perhaps wait till a little bit calmer, less choppy waters before they can easier to navigate, particularly if you're a retail person kind of diving into these waters for the first time. Let's head on out to Mr. Rock Lobster. Sir, same question for you. What are your thoughts on these overall somewhat high valuation levels we're seeing out there? Maybe you disagree. Maybe you think they're too low. Maybe you think the bull is in force. And what are your thoughts on what we're seeing out there from an equity volatility perspective as well, sir?
Well, oh my gosh. So like you're looking at, has there been a hotter contract than the E-mini rushing 500 points? I don't think so in the last 2 weeks. A lot's happened. I mean, you want to think 2 weeks ago, think about just how just everybody was like, oh my God, this totally stinks. And then all these states are getting shut down. And quite a turnaround, I think. So, are we getting ahead of I still, I am happy that the market is euphoric. I'm happy that it seems like we're looking to get past what's going on. But it's still, a lot of unknowns, and I think it's all, from a vol point of view, it's all sort of fairly priced at a high vol because I think that, there's somebody flips the switch, it could be substantial one way or the other. It's hard to see like we're going back to all-time highs when the government just spent all this money, and I mean, even the Fed is basically they're basically holding on to assets when everybody wants them back again, as far as I could tell. I mean, they're going to probably end up making money on the whole thing like they usually do. The government sending checks to people, oh, that's good. That's getting people over the hump. So all these are positive, but ultimately we got to get back to work. And as far as from the next thing, we were talking about oil, right? I'm looking at the pretty big swing. I'm looking at stocks like Exxon had a 10% move today.
All right, hold up. I'll cut you off there. We're not quite at oil yet, sir. I want you to keep your powder dry.
Okay, sorry.
I know you've never done these shows before.
Right. Vol, I think is fair. It's fairly priced. It's going to stay like this. And in the actual, from the E-mini point of view, it is kind of given. It was up 2% today. It's only at 1% now. So it's starting to give back a little bit. We'll say it's giving back a little bit. Maybe that 10% unemployment it might shock people a little bit.
An interesting point on our last show as well. By the way, check out the option block if you haven't done so already, listeners. Interesting point about how some of the volatility space used to be some good opportunities out there. Long straddles, long strangles. Volatility was paying off. Not so much these days, but gamma. If you don't know the difference between vol and gamma, listeners, I encourage you check out some of our options boot camp, options playbook radio, those types of shows to break all that down for you. But some nearer term gamma in things like the S&P 500 could certainly be paying off right now. Let's see what's paying off right now out there in S&P 500 land, the E-mini. By the way, listeners, you guys, as always, can play along the home game, cmegroup.com/TWIFO. Go to that equities drop down, choose the E-mini S&P 500. That's where you'll get to this. We're at about a 27, or coming into showtime, we're at about a 27. 66, almost 67 or so out there in that front future. That contract has, a whopping 0.05 days to go. So pretty much going away any minute now. And that's, if you watch equities, that's what people like to play. Like to play in those contracts that are going away any second, because the 2,800 calls, so the near out of the money calls, are the big number one most active contract out here in the E-mini today. They've done 20,100 all week, 11,200 today. So folks are feeling some of that upside action out there today. Obviously, we don't have OI numbers for today, but the rest of the week seemed like it was a little bit back and forth, mostly slightly biased towards opening out here. Then we drop off a little bit again. We get out to, looks like actually we have to go out a little bit now. We have to go out all the way to, let's see, where are we? We're out to April for the 2,100 puts out in April. Interesting. 2,100 puts doing almost 19,000 contracts. The lion's share coming on Monday. It looks like someone unwound a bunch of those on Monday, because that was about 17,000 went up almost on Monday alone, and about 10,000 of that was closing. So huge taking off of pretty extreme downside puts there in the E-mini on Monday, which is kind of interesting. Maybe someone deciding that the floor was in and they didn't need that hedge anymore, or it had worked out enough for them to take it off. Either way, it looks like size downside closing on that 2,100 put strike. Interesting. Not exactly the strike I would have chosen, which is why these reports are so fascinating, listeners. 20% of the overall paper this week was in that week 2 April contract that's going out in a few seconds here. Let's go out to a little bit. So let's see if we can find another contract that has a little bit more meat on the bones. Got to go out to June to get 17.5% of the paper was going up out there. That's where. Let's look at the SKEW really quickly. The puts last week, 24.6% rich. This week, coming in a little bit, 22.3% rich. So not exactly perhaps surprising given what we've seen out there. The calls, 18.5% cheap this week. Cheaper. Almost 21%, 20.9% cheap from the at the money vol. So interesting stuff here across the board. We could parse some others out here, but we got to keep rolling with some other contracts out there. The Rock Lobster, you can see him. He's already champing at the bit out there to get into the slippery stuff. So let's get into it. Again, grab that drop down, listeners. Head on into energy. Click on WTI. I like to hit select all, but it can be overwhelming if you're not ready for it. So bear that in mind as you're choosing which expiration months to display their listeners. So we, of course, have seen this kind of will they, won't they dance out there over the entire week pretty much with OPEC and Russia. Will they come to terms? There was a lot of talk earlier in the week that they were demanding the U.S. make some production cuts as well before they would be willing to step into the fray. Reuters and others are reporting earlier in the day that it seemed like the agreement was around 20 million barrels for a production cut, but that wasn't firm. And there were some folks out there questioning whether that was even viable. 20 million is a lot. And yet also, so A, is that sustainable? B, is that even going to make an impact with so much demand destruction out there? There's only so much you can do on the supply side, and is that even enough to really make up for the demand, pretty much annihilation we've seen as a result of the coronavirus. So yeah, the number is looking at about 12 million barrels a day for OPEC, coming out of Reuters, and the OPEC Plus group getting about another 5 million. So not quite 20 million, it's like about 17 million. That number is down to as well. So we saw the numbers, we saw WTI jumping for a little bit. Now coming into showtime, it has given up a lot of that ghost here. And on the week now, it's off about 5 handles. It's down to about 23 and a quarter in that front contract. That's about a week to go left. That's off about 17% on the week. That front contract, so again, kind of putting the lie to the fact that people won't trade near term in WTI. That front contract is also where about 41, almost 42% of the paper has gone up this week. And I said we're at about 23 and a quarter right now, and we're looking at the 20 puts leading the dance out here with 23,600 net on the week. The biggest day is actually today. We've already outpaced Monday. Monday was about 6,600. Today, 6,700 on the tape. So today is a big day, but it's pretty even paper throughout the week. And it's been back and forth on this strike because it's been net opening of 38 contracts. So a lot of back and forth on the week here on this 20 put strike here going away here in May next week. Right behind that, we've got, looks like 30 calls, 14,500 of those going up this week. The lion's share of them today, perhaps not surprising, earlier in the day, as we saw, maybe the rally was in, and then not so much. To the total of 6,500 today, the rest kind of evenly scattered throughout the week. Net slightly opening earlier in the week, so folks were kind of loading up ahead of this OPEC announcement. Makes some sense, and we saw about 6,500 going up here today. Let's go back to the SKEW. You know, I hate parsing SKEW in a name that has less than 2 weeks to go, but 41% of the paper went up here this week, so we kind of, all right, I'll break my own rule just this once. Don't tell anybody, listeners. Right here, SKEW-wise, we're seeing, let's see, the puts were almost 10% risk. They had the money in this 1 week to go contract here in May. And with, let's see, this week, they're a little bit more bid, 10.5%. So a little bit more bid to the puts. The calls, 5.5% cheap this week, 6.7% cheap. Kind of reaffirming that narrative. Even on a week where we saw a pretty strong rally coming into today, still that call wing can't catch a bid out here. We talked about that last week, too. They will continue to fade this. And they have faded it, it seems like, yet again, even in a very active contract out here. Let's go back because he was waiting so patiently. He couldn't wait to get to the slippery stuff. Mr. Rock Lobster, I know a lot of you are crazies in your pit chat when they're not slinging themselves some volatility products, like to look at things like the crude. They look at it through a variety of different lenses. Could be WTI, could be also indexes like OIV, could be products like XLE and USO. What are they looking at? What are they up to? What's going on out there in the pit chat with your crazies and crude these days, sir?
We are the pit crazy are selling some puts in WTI, somewhere below the 20 level. So that's kind of what we are. I just had to think, like, you got like Putin and you got, what's his name, MBS, the ruler of Saudi Arabia. You got a couple of guys with big egos, but ultimately, I think they need oil prices higher. They make more money pumping less at 40 than they do at 25, and I think they got to get on board to do that because they need to make money all of a sudden. A couple of weeks ago, it might have sounded like a good idea, but maybe it doesn't sound so good anymore. So I would just say I would expect oil to kind of stabilize and they start cutting production, and probably the U.S. will start to do it as well. Don't know how the Donald will jibe with that, keeping oil prices higher, but you don't want to blow out all of the producers all over it because they created a lot of jobs. So anyway, that's what I did. I actually sold some puts myself. So about 15 minutes ago, to be honest, I just got filled. And we'll see, I'll see what happens. I think there will be a deal. I think they need one for and this is what has happened before. Saudi Arabia has historically says, okay, you guys don't want to cut production. I'm going to screw all of you and we'll just flood the market with oil and you could all, suck on it basically. And I think at this point, everybody else, I think they want the revenue and they'll just do it a little less. So we'll see how that goes. And I said, a lot of the major oil companies had 10% round trip prices today alone, 10% per day in a big name oil company. So I'm looking at, even looking at equities as well. I know this is a future show, but I think there's some potential for the equities to pop too. Or they're going to go back into the ash can where they came from, and it might be put some oil at very low prices. But that's where I'm going on this one. That's where I'm going.
Yeah, I was with you on the fade. I was playing some everyone's ETP. We always love to take shots at on this. Not just VXX, a few others like USO, predictably crappy. And I was doing some ratio put spreads out there to try to fade this announcement here this week as well. I have to go take those off, so excuse me. No, I'm just kidding. That can wait till after the show as we keep on looking here. But yeah, USO taking a bit of a drubbing as well. It always does as well. There's a lot of issues with USO as we've talked about many times here on this program, which is why sometimes it's fun to fade it. Like a time like now. Mr. Uncle Mike, I know you like to look at a lot of energy. I know your preferred vector in the past used to be a lot of short puts in XLE, but I know you watch a little WTI and some USO and some other things out there as well. What is lighting up your tape out there in the slippery stuff these days, sir?
Well, I mean, the slippery stuff, we're in a unique time in that we're really waiting on it's very much the future of our economy in a lot of ways is tied to oil. And like what Andrew was saying, it's they like making money. And so it's one to where where they're going to go with this, they're not going to let crude oil go to zero. And so I'm definitely more of a fan. I mean, I don't have a huge position. I mean, for my clients with what I do, most of our oil exposure comes through XLE, just because we're more stock oriented. But if I am going to take a commodity position in oil, I mean, I think there's definitely more room to the upside than to the downside. And with vol at levels with which it is, if you're willing to take on the underlying, you can sell puts in crude. So let's say that back in the day when the big crude oil contract was, let's say if oil was at 50, then it's a $50,000 contract. Well, now with crude oil right around in the 20s, it's a much lower contract. You can almost trade crude oil right now like you would, just depending on the size of your portfolio. If you're a put seller as an equity trader, this is a unique time in that you can almost be a cash secured crude oil buyer, meaning you have all the money there in case it were to go to zero, and you can sell puts in it like you would normally with just doing it simply with equities. And so it's not often that you see that in the futures world. So if you are looking to be a put seller and you're bullish on crude oil, and you've always been concerned in the futures world that, well, it's a huge contract. I don't want to take on the margin maintenance of it. And I don't like trading on margin. I don't want to have my money elsewhere because what if I get a margin call? Well, if you put the 25 grand or whatever it is that crude is at right now, you can be a crude oil put seller. And it's a very similar effect as to what you're doing when you're selling puts on equities. You're doing a one lot that represents that much, but you're not going to have a margin call because you're already going to have the cash in hand as well. So I think that if you are going to take a position in oil, I'm definitely more of a fan of being bullish on the futures contract as opposed to whether it's the big contract or the mini contract. Definitely more of a fan of that over a USO, but typically with what we do, we're more stock oriented here at St. Charles Wealth Management. So our exposure to the slippery stuff is done through XLE primarily. But if you're bullish on it at this point in time, like I said, very unique time in the crude oil history, to say the least.
Indeed, sir. Speaking of unique times, we have to roll on to another product category. I know you like Mr. Uncle Mike, and wasn't lighting it up this week net on our movers and shakers, but it's so much in the headlines, we kind of have to talk about it right now just because it's of course, it's the shiny stuff. It is gold. We're seeing gold coming into this week. Now, once again, we've said this before, when it all hits the fan, correlation tends to go to one. We're seeing that again today. Gold up as the markets are up. Which in the broad perspective makes sense because a lot of the news outside of the Fed whispering stimulus in the market's ears, outside of that, a lot of the news is pretty horrible. And so gold probably would respond to a market like this with a rally, and that's exactly what we're seeing out there as a result. Yet again, putting a light to the notion that gold is a pretty crappy portfolio hedge a lot of the time, particularly when you need it, like right now. And we've said it before, we'll say it again, broad equity volatility, whether it's in a VIX or some sort of long equity type play, long volatility play, I should say, in the equities, is pretty much your only real reliable thing, as well as, of course, the direct portfolio hedge of a broad index or an individual equity type put, depending on what you're trading. You know exactly what you're getting there. That could be expensive. We talked many ways about how you could pay for that over the course of our broad 13 plus years here on the network. But in general, those are the only two quote unquote hedges you could really rely on in these crazy troubled times. As we've seen, everything else went to one. Crude oil sold off. A lot of people like to diversify in that. Metals sold off. We saw people, even Bitcoin, this supposedly uncorrelated asset, took a drubbing, selling off 30% intraday at times. So if you want a reliable quote-unquote hedge, and you don't want to just ride the market up and ride it right back down, then unfortunately gold ain't going to do it for you. And let's get out to gold, though. Gold's still at its highest level right now since October 2012. Of course, the dollar has a lot to do with that as well. The dollar heading a little bit downward with the Fed whispering stimulus in everybody's ear. So that, of course, lifting gold out there as well. So we haven't seen these levels since in 7.5 years, listeners. 1728 right now in that front gold future. That puts it up 5% here on the week alone. So a bit of a rally, shall we say, out there. If you look just at, remember that week, that scan moving on week to week, that goes back to our show of last Thursday. This week in future scan that you're looking at just starts on where the markets start this week. So just from a pure this week perspective, gold's actually up. Actually would be near the top of our, well, not near the top, but in our movers and shakers to the upside quite a bit. Let's see here, at about a 1730. The big contract out here right now we're going out to June. It's the June contract. That's done about 33.6% of the paper out here with the big print. 17 half calls. Not surprising. That's a near out of the money call. How crazy is that? How long people kept saying gold can't break 1600 to the upside. Now we're talking 17 half calls are where the action is right now. 11,000 of these have traded so far this week. The lion's share coming, surprise, surprise, today. Nearly 5,000 of that 11,000 coming today. So the rest of the week, kind of back and forth. A decent day on Monday, too. About 2,500 going up on Monday, the lion's share of that opening. Today, obviously, no OI numbers for that, but 11,000 of those bad boys are leading the dance out here quite a bit. I like to go out a little bit in gold, too, see if there's any funky prints. Don't see too much crazy funky prints. It's these 17 halves. Also see 1800s going up here. Worth knowing there are about 2,400 1800s and 4,900, almost 5,000 17 halves. So we know there are some ratio call spread players out there in gold. Maybe a 1x2 1800 17 half. If he's doing it an interesting way. He's doing it 2x1, which is an interesting ratio to have out there if you were indeed so inclined. 2,500 almost of the 1800s going up today. About 6,300 total on the week out here. So maybe some ratio call spread players afoot. I'll have to dig in a little bit more to see for that. Looking at the vol out here really quickly. Of course, vol in this contract has this June contract has about 47 days to go. So it's kind of interesting. Vol actually coming off a little bit, which is kind of interesting given all the moves we've seen out there of late. The puts were slightly cheap last week. It was all calls pretty much. It was about 1.5% cheap were the puts this week, about almost 5% cheap. So the puts coming in, again, not that surprising. The calls were almost 5% rich to at the money this week, 9.3% rich to the at the money. So the calls getting some love. Again, not surprising. 7.5 year highs out here in the shiny stuff. Mr. Uncle Mike, let's start with you. I know you like yourself some shiny stuff. Anything catching your eye out there in gold? I know you've never been a gold hedging guy. You always like, instead the more direct, the S&P puts, and indeed some volatility plays as well. But what are your thoughts on the shiny stuff? And then also, if you would be so kind, we only have about half an hour left. So I'm not sure, actually not even 20 minutes left. I'm not sure that's enough time to break down all the action that you've done. But if you can squeeze the action on your 2-year silver collar into that time frame, sir, then have at it.
I wish I could, but I can't. So what I like about the shiny stuff is that, number one, over time, I do believe that over the long term with inflation, that the shiny stuff is a good spot to be for a portion of your portfolio. The other reason that I like it is the fact that you have a reverse skew that exists on the metals, meaning that the calls cost more than the puts typically. So when doing so, if you want to put on a collar trade, then you have it's kind of nice to do. And that, let's say you go long a silver contract, you can sell a call option further away from where the price of silver is or gold than you could for the put. So essentially, you have a built-in favored risk reward. So that's one of the things those two things are what really draw me to the shiny stuff, both silver and gold, primarily silver with me. But on here, I think what's interesting to watch about gold, if you look at it, I'm looking at a 20-year chart of it right now. It reached its peak in late 2010, probably about maybe about 10, 15% higher than it is right now. But it'll be interesting to see if all of this money printing that the federal government is doing, with all the stimuluses, with all of everything that we have going on, actually continues to push it over the top. Gold is something that often does run with the dollar. So if you're a dollar bear, then oftentimes gold can really help you because it has a lot of times it does have the inverse relationship with it. So I think right now gold's kind of an interesting time in that will it be able to establish itself above the 1600 level? Or I'm looking at GLD anyway, will it be able to go through the 160 level, at least on GLD? And if it does, is that something to where it will be able to use that as a support to springboard itself higher? We're still a ways away. Like I said, we still have about another 15% to go to get to our highs that we made in late 2011. I'm sorry, I think or mid to late 2011. But we're not that far from it. So it'll be interesting to see everything with which we're doing it. Now, to update on my personal, on some of the positions with which I'm in, what I set up with silver about a year ago was something to where I can't give the strike prices away on it just for compliance reasons, but I set it up to where I was long the underlying, and I would actually buy an at the money put, and then I would sell a slightly out of the money put, and it would be set out to be a no risk trade to where I would make somewhere between like 0 and 10% over a 2-year period. So my thought process behind that was that 10% over a 2-year period with no risk to the downside. I liked that. Now, granted, I wasn't guaranteed that. I would need silver to go higher for that to happen, which it still could. But that's along the lines of what I was doing with a very tight silver collar. A more loose silver collar, same concept, but I would just have a lot more upside available and a lot more downside. But nonetheless, we were still able to set it up from the standpoint that we were able to have much less downside risk than we had upside potential. So that's kind of where I'm going. What's going on with in the world of shininess with Uncle Mike.
I'm still not on board with the gold as a diversification tool. I think the one interesting nugget out there is that, you're right, the SKEW, as I just pointed out with the SKEW report lately, the calls are nice and juicy. So from a collar perspective, if you were to put on a position in the shiny stuff, silver to a lesser degree, but still there as well, it is favorable from collars for that perspective. So that's one sliver, one ray of hope in the shiny stuff's back pocket, even though otherwise, I think overall as a portfolio hedge, I'm not quite sold. Mr. Rock Lobster. Your crazies like themselves a little bit of the shiny stuff every now and then. Usually for the better part of the last year, outside the last few months, gold has kind of been dead money from a vol perspective. Gold vol has been nothing short of anemic, so it wasn't even really worth it from a harvesting perspective. What are your thoughts on that contentious issue of whether folks in this day and age should still be allocating some percentage of their long equity portfolio to the quote-unquote diversification magic that is gold, sir?
Wow. I just as they're talking, I just bought some Exxon Strangles, so I'm going to hold them for a couple of days.
Look at you just slinging all the vol in Exxon, sir.
The gold, I think a lot of the pit crazies have just been using like vanilla momentum type stuff. And I think it's been a good momentum play. It's been like kind of a good long gamma play, pretty decent. And that's mostly what they've been doing. I don't know if they use it as much as a hedge, as mostly just as a momentum play. If things start rocking and rolling a little bit. So, it tends to trend very well. And I think it makes, you want stocks, things that are going to move in one direction. So gold futures, they move in one direction. So when they decide to, so I think that's a good, that's definitely good, a good play that way. So that's mostly what at least my students have been doing vis-a-vis gold.
And speaking of your students and what they have going on, I promised on our last show we didn't have a lot of time for questions. I promised we'd make sure we squeeze in the folks on this one. So without further ado, let's get to some of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to your segment, Futures Options Feedback. See how much we love you guys here, listeners. We're missing good trades because we want to be here talking to you guys and answering your questions. That's how much we love you guys out here, even though that transition did buy me some time to try to close some stuff out. So we'll see how it goes. All right, going on to, let's see. You guys have a bunch of stuff on the brand. Oh, Mark Brandt, our buddy there, he's disagreeing. He says the only safe haven out there is Gold Eagles. So he's liking himself some gold. That surprises me because I know he likes himself some deep in the weeds kind of option strats. So he's liking himself some gold. Well, I guess if you like your diversification assets moving in lockstep with the rest of your portfolio, then gold is a great product to have in your portfolio. I can't wait. I can't wait for the gold bugs to just come at me because in the past when I've ever been dismissive of gold, that's usually lit a fire. They're a pretty vocal bunch. They've been somewhat quiet of late. Let's see if that jogs them out of their stupor. Let's see. Job Board Finder. Interesting handle. He's chiming in saying, wow. He just has wow. Exclamation points. He's talking about how terrible. We were talking about the terrible jobless claims numbers. Yeah, I'm with you. I think wow is about all you could say. The market's saying, yeah, give me more in terms of stimulus. It seems like they're shrugging off the fact that we're at 13, almost 14% unemployment, depending on how you count it out here, with just ridiculous numbers of jobless claims every week. But the market, not minding it all. Let's see. I just like this handle. I see Whackness chiming in, saying he sees the collapse in oil prices, then he's going to wait for stocks to tank and then buy them up. Well, so far at least, I'm not sure if I would call it a collapse, but a recent retreat, to be fair, out there in oil prices. As we're seeing, of course, some concerns over what's going on. I'm getting partial fills out here. What are they doing to me? Fill me. All right, let's see. Yeah, so far at least it seems like we've got, I don't know if stocks are tanking. You're not getting that part yet, but you're getting a little bit of a pullback, shall we say, in oil prices. At least until we get some more certainty on what the hell is going on out here in regard to all things crude. Baiju Thomas writing in saying, hi. Well, hello, Baiju. He's got an interesting question. He says, your episodes don't seem to be updating on Spotify as and when you release. Like if you look for any shows from this week on Spotify, you will not find it. So I downloaded your app, but I prefer to listen at a speed of 1.25x. Wow, that's a very specific speed there, Baiju. He goes, but on your radio station app, you can listen to at speeds of 1.5x. That becomes too fast. Any solutions, please? Thanks, Mark. Much love from London. Great shows. I've learned so much. Well, thank you for that feedback. Baiju and all of you out there, we love all of you. That's a good point. Actually, when this came in before the show, I really quickly went and checked on Spotify. I'll just give you a little glimpse behind the scenes of how the network works. We used to, back in the early primordial ooze days, upload all this stuff manually to all these different outlets. Because the network was a much smaller beast, it's obviously much bigger now over the past 13 odd years. So we have a network distribution partner. We upload it once to them, and then they upload it out to all of these various outlets, including YouTube. A lot of you guys loving the YouTube. I forgot we even had one. I got a notice the other day how many subscribers we've gotten, and some congratulations message from YouTube. I forgot we even have a YouTube, but that's one of those outlets that they just automatically distribute it to. And a lot of you seem to like it there, so keep enjoying it there. But I did check, and you're right. Looks like some hiccup went through between our network distribution partner and Spotify. So if you listen to Spotify, the last show they have is like Crypto Rundown from last week. I'm not sure why. So we'll look into that. In the meantime, I recommend you do what Baiju did. Go check out our app. It's got everything in there. It's not going to go down. I don't know what to tell you about the 1 1/4 speed. That's not exactly a normal speed. Maybe some of the other apps like I think I like myself a little bit of a Pocket Cast. I'm not sure if they have 1 1/4 speed though. That's an interesting speed. I don't know how to help you there, Baiju, but keep listening. You did the right thing. You went and grabbed our app. So if you're a Spotify listener, you can of course get it on iTunes. You can get it on our website streaming there. A lot of you like it on YouTube. You can get it from there, or of course Stitcher or our app, all still working out there as well. Google Podcast also working as well. All right, here. Let's see what we've got. More stuff here. Here's an interesting one. COCL wants to know, when you see that a call SKEW in a stock is bid over the puts, is that a sign that you should immediately sell that SKEW? Immediately. Interesting. Uncle Mike, you were just talking about SKEW. I'll let you get in here on this one. COCL. So, Uncle Mike, you see he's talking about an individual. I'm assuming it doesn't mean broad indices. He means an individual name, but maybe you can talk about broad indices as well. Of course, it's a little bit weirder if it would happen in like S&P 500. That would be very strange. It has happened, though. If you see in general, Mr. Uncle Mike, call SKEW getting bid over the puts, again, that's not the normal SKEW situation we see out there. Is that a sign to you that you should instantly hit that SKEW, sir?
No, not at all. What I do in situations like that, I actually have my little SKEW fund for clients that are looking to do something that's like maybe better than a savings account. So, for example, I did this with I'm not in anything right now because the SKEWs are not there. But over the last couple of years, I've done this with a client. Let's say I'd have them buy 100 shares of Amazon and then maybe buy an at-the-money put and then sell an out-of-the-money call. And they'd essentially do it for zero cost. Meaning in terms of the call and the put. And so what that does is that creates a situation to where I can look the client in the eye and say it's mathematically impossible for you to lose money unless our whole financial system collapses. You have full protection to the downside on this stock. I don't think there's anything there right now, but I've done it with Amazon. I've done it with Facebook. I've done it with Google. I've done it with a variety of names. A lot of times the FANG names were more popular with this. And so, excuse me. And so what I could do is for a higher net worth client that is looking to have a safer investment over the course of a year or so, you could set something up like that. So that's how I would use it. That's how I've used silver as well. And so the general concept behind it isn't necessarily good or bad for the underlying. It just means that there's more call buyers than put buyers, and the SKEW is more towards the call options. So when that's the case, I can set up a costless collar oftentimes with no downside to it. And usually it comes out to my general rule is that if I can beat the government treasury for that point in time or double the government treasury of that time, let's say it's a 2-year trade. If the U.S. 2-year note is trading to where it can get, let's say 1%, I'm looking to get between 0 and 2%. Or if it's higher than that, of course, it's better. But usually the minimum of where I want to get in is I want to double whatever the U.S. Treasury is for that time frame. And that way I can say, okay, you're either going to make nothing and you'll miss out on what the Treasury was, or you're going to double what the Treasury was, one of those two things. And that's how I like to use it whenever you see an individual name with that type of a SKEW that actually has the ability to do those things. So that's what I like to do with it.
Well said, sir. Or should I say, Mr. Rocklops, I'll let you chime in on that. Also, since we're not going to have a vol views tomorrow, don't blame us. The markets are closed. So blame the Good Friday holiday out there. I'll let a quick vol views related question sneak in here as well. This comes from Nigel. He's just saying, I don't get it. Isn't backwardation in the VIX futures good for VXX? Since it's got futures and options on those, or related options, I should say, not quite on the futures, then I'll allow this one to slip in here on TWIFO. Mr. Rock Lobster, this brings up an interesting point about backwardation out here as well. By the way, I want to touch really quickly. I was chatting with Mr. Dave Lincoln on the Short Vol show this week. We had a lot of great questions. One of them, someone wrote in about long-term buy and hold in these ETPs, these vol ETPs, like VXX and others. And we talked a lot about how the long-term buy and hold strategy is not good because in usual scenarios, you're going to have that contango, which hurts a product like VXX. We didn't get a chance to mention, we kind of got sidetracked, that right now there's backward. And so that is actually going to, you say it's good. I'm not sure if it's good is the term I would use, but it does help it support and mitigate some of that negative roll yield you're going to see out there. Mr. Rocklops, I know you guys have worksheets about all this stuff, about how that VIX futures curve breaks into a roll yield for VXX. Break it down really quickly for Mr. Nigel here, wants to know how that impacts it. And also if you have thoughts about the reverse investment skew, if that's a good setup for you, have at it.
So one is, the first thing is the backwardation definitely pulls the futures up because the cash is higher. So all the assets that VXX own get a little bump, as time goes on, the decay is upward. So the thing is right now is how much is it? I think VXX is decaying around 20 cents a day or something around there. So it's not a whole lot. UVXY is 50. So, but per week, that's maybe $1. Remember, VIX stays flat. So that's why in general, when you're in backwardation, I tend to lean long. But it's also, where the futures are one thing, but it's also where the futures are going. Are they going fast enough to warrant buying anything? And I think that's the problem right now because we're definitely a 40 vol market, 40 plus because of the moves. But the problem is I don't think we're a 60 vol anymore. So, if this crisis is kind of abating and now we're just trying to get back to work, we're just not a 60 vol, which makes it hard for VXX to go up, quite frankly. So that's sort of why we're sort of sitting where we are at this point. As far as SKEW goes, commodity SKEW and SKEW on futures is different than equity. So a lot of times calls are more expensive in gold and silver and live hogs and everything else. I mean, so the SKEW's all kind of, SKEW generally is unique to the product because they all kind of have different things going on. But that's where that's how you want to look at that. So you want to do things in my mind that are sort of SKEW positive. Just buy the cheap stuff and sell the expensive stuff. Try not to make it too hard, but that's where that's going. And even the vol products trading volatility on the futures are going to have upward pointing SKEW as well. So with those things in mind, that is how we'll be moving into the end of the show.
Speaking of the end of the show, that music means you come up against it. If you want more information about how to trade the SKEW or how to things like backwardation affect certain products, the Volatility View show, great one to check out. Like I mentioned, not going to be on this week, but the archives go back a long way. You can certainly sink your teeth into those while we're off for this long holiday weekend. Like I said, that music means it's time for us to end, really. Unfortunately, our broadcast week, this is it for the week here. No shows tomorrow. Sad face for me here. But before we go, let me go back around the horn. Let's start with the uncle list of Mike's. Did Able Duty filling in on that old CME group hot seat today. Mr. Uncle Mike, sir, if folks are intrigued, they have questions like this about SKEW, about volatility, maybe they just want someone to talk them off the ledge in these crazy markets, and who can blame them? They are crazy. Where should they go? What should they do, sir?
Well, by all means, go to stcharleswealth.com and we'll take you off the ledge as best we can. You can make an appointment to talk to me right there on the site, or feel free to give me a call at 630-885-0017.
00. He's a 00 out there. So check him out, stcharleswealth.com. You probably want someone like an Uncle Mike to talk you off the ledge and just hold your hand or just babysit your positions for you while you're doing something else. So maybe not a lot else going on right now, but you can get distracted. Go watch your Tiger King. Let Uncle Mike watch your portfolio for a little bit. So stcharleswealth.com is the place to go. I think he has that on his business card. Go watch Tiger King. I'll watch the markets for you. All right, Mr. Rock Lobster, if I want to get nitty-gritty, I want to really get in there on these topics like backwardation and how they impact things and SKEW and all this fun stuff. Maybe I want to join a cool vol trading club. Where should I go? What should I do?
Go to the Option Pit website, optionpit.com. Look at mentoring. Look at our mentoring page and see all the stuff that you have. We spend a lot of time teaching people how to trade options. Probably more than you'll ever want to know, but we've had students and customers that still are in our chat room 8-9 years later, and they're happy, they like it, and they're doing fine. So if you're interested in that kind of learning, come on over to Option Pit. We'll be happy to help you.
Speaking of your longtime clients, I think I see one of them in our live chat right now, Mr. Hawkeye. I believe I met him at one of your events. So like seeing all those regular faces floating in. A lot of you have been coming in and out of the chat over the course of the past week. So keep it in, keep it coming, keep those questions coming. Stay safe out there. These are crazy times. Stay home. Keep your position small. Listen to our shows. We'll talk you off the ledge. Again, no vol views tomorrow. We'll be back again on Monday for more of the entire network. So enjoy it. We'll see you back here on Monday. Stay safe out there.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.